Yes.
Okay, thank you. Let's wait a couple of more minutes and then we start. I'm assuming that most of you have already returned your coursework. I'll try to have it to have the grading as soon as possible, hopefully within the weekend. So I can come back to you and give you some feedback about what you have done, so that you can, proceed better also for the second one. And now an issue is that many of you might have the problem regarding Turnitin. This system tends to show high rate at some point, and this usually happens when one part of your literature is very close to the parts of other, papers. So, for example, you took practically verbatim from the paper that you had as a key paper, and you put papers one after the other that were very relevant. This is when this happens. It's very likely that your level of Turnitin will increase, the similarity index that is, and it might be the case also that in some cases people when they have to do coursework in multiple courses, they might have uh, similar topics, and therefore they return the same or similar paper at the end of coursework. Of course, when this happens, then it's also very likely that similarity index is very high. Fortunately, that's not the case for most of you, but I understand that it might happen as well. What I want to tell you here is that generally, when you have this kind of cases whereby you have to also, have two pieces of coursework that are quite relevant to each other, try not to have them. Try not to hit two birds with one stone. That is, use one coursework for both of them, because in this case, there might be a problem. Regarding your essay, you have to go to in order to submit your essay, you have to go to the system and submit it. My understanding is that even one person can submit the coursework, and therefore the system will understand, will put into consideration also the other people. Because when I checked yesterday evening, out of 102 people, it said that at least 90 have already submitted. So I'm assuming that even if one person submits, it takes into consideration the whole group. But yesterday, what I did was to also create another area where you hand in specifically your peer evaluation, these two forms together. This form only I can see. Therefore, you have to be truthful there. Everything that was wrong in your group, everything that went well in your group, you can tell me so I can see them. So there is no problem not being truthful. So if you haven't done that, please do that over there as well. Any other questions regarding the coursework that you might have? And we try to solve it as soon as possible, because the deadline is in 2 hours practically. Any other problem? Okay. Okay, let's go. What is the topic for today? Today, again, of course, we'll talk about capital structure, but prior to doing this, what is the agenda? First, I will go in a quick overview regarding the material, and then we'll discuss Moodle activities 3 and 4. I have seen that one person has actually tried to participate in the Moodle page forum regarding the data case. I have told you, I knew that today, this week you had many courseworks to return. So I told you could also work on this even for this week. That's fine. One person did this, but I will also post on the relevant section Moodle. I will post the potential solution for that, along, of course, with the discussion for activities 3 and 4, which is what you see now here. Prior to going to the activities per se, let me go to an overview of what we have already captured, what we have already done in this capital structure sections or unit. Of course, what we wanted to tell you here practically is one important part for a firm's life, and that is how to finance their investment. And usually, firms have two ways to finance their investment, either debt or equity, or they can use a mix of both of them. And what do they do this? What do they do this kind of, financing? Of course, they need financing for investment. Investment is needed for a firm to go forward and to be able to, to continue thriving, if possible, in a very highly competitive market. Now, there are two types of firms. When firms do not have any debt at all, they are unlevered firms. When firms have a specific amount of debt, even a small amount of debt, then we say that they are levered firms. Now, an important question that rises usually in this kind of topic is whether or what percentage of debt or equity firms should have in order to maximize their firm value. And here is where, the Modigliani-Miller 1958 American Economic Review paper comes and tells us that it doesn't really matter. If markets are perfect, it doesn't really matter whether you use how much equity you use or how much debt you use or a mix of them. It doesn't matter because at the end of the day, the firm value will remain the same. And this means that under perfect capital markets, the optimal would be any level of debt or equity. But as you can understand, and that's important here, is that usually first and foremost, markets are not perfect, right? Because, for example, you have taxation, and there is a specific case of taxation that you had to read as well in chapter 15. Taxation or other asymmetric information, the inability of people to buy or sell the same type of securities or have access to all types of securities, any other type of asymmetric information, etc., could potentially affect this outcome. Therefore, in reality, capital structure matters because the Modigliani-Miller theorem cannot hold under imperfect markets. Now, usually when firms try to have debt, they introduce debt as well, and that's an important decision because leverage is a sort of additional risk for the firm. There is a risk because there is always the possibility that firms might not be able to pay back what they borrowed in the first place. And of course, this thing is what investors know, and when this happens, they demand a higher price for their relevant investment. And of course, when there is a higher risk, this kind of levered equity, therefore, will have a lower price. You want to be able to sell something in a smaller price when you know that is riskier. Of course, the return will be a different story. The point is that the entrepreneur will be indifferent under the perfect capital markets and when the Modigliani-Miller theorem functions or works. But generally, the leveraged equity is riskier, okay? And therefore, when this happens, individuals or economic investors require higher return. An important issue for the Modigliani-Miller, apart from MMN1 and MMN2, is that sometimes firms require a specific level of investment, and therefore they use specific amounts, percentages of debt and equity. But the thing is that sometimes you have specific shareholders within the firm who would prefer a different level of debt or equity. That's not a problem at all in this model as well, because they can have the so-called homemade leverage. This means that investors might have different level of portfolio, and they can borrow or get shares on their own, and this will not be a problem to the Modigliani-Miller theorem. And of course, this is the so-called homemade leverage. Now, having generally information about the equity of a firm or the value of the debt of a firm, we can measure the so-called market value of equity, the general market value of equity by just looking at the balance sheet of a firm. This would practically mean the market value of assets minus the market value of any debt or any other liabilities. I wanted to remind you here that when you say that the value of the firm is shared, and then for the different shareholders, that is individuals who possess shares for the firm, but also at the same time, it is when a firm has debt, also people that they have practically help the firm by providing the loan to it, also practically hold a part of the firm. Therefore, value should also matter for them as well when we measure the total value of the firm, the value that is because of the debt holders. And going forward, apart from the Modigliani-Miller theorem one, which, as I stated before, under perfect capital markets, the level of equity or debt does not matter in terms of optimality of which one to use. But there is another issue here. When you have debt in your firm, and then you can see that the cost of equity in this case would be usually higher than the cost of unlevered equity. And also this cost of equity, when you have debt, increases with more debt that you have. This is the so-called Modigliani-Miller theorem 2. And practically it is the equation that says that RE equals RU plus D over E multiplied by RU minus RD. As you can see, this relationship here has the ratio D over E, and the D over E is with a positive sign over there. This indicates that as D over E increases, that is, as debt becomes bigger and bigger, so much the RE will increase as well. And this is what it is here. Apart from that, apart from having this different information for the different cost of equity, we can also go to the average cost of capital, which is the weighted average cost of capital, the WACC, as we say. And according to the Modigliani-Miller theorem, the average cost of capital will have a return that is equal to the return of the unlevered firm. And again, this will be a weighted average of the cost of equity and the cost of debt. And what is the weight? The weight for equity will be how much equity you have divided by the summation, the sum of equity plus debt. And the weight for debt will be how much debt you have divided by how much equity and debt you have in a firm. Now, when markets are perfect, the WACC is independent of this and remains the same. We'll see that this is not the case when we have taxation, as it changes. Taxation gives other prerogatives for the firm, avails the firm in other ways, as we say. Now, it is possible that this relationship between the cost of equity, unlevered and levered equity, can be also translated in the form of betas. That is indicating the relevant risk of having only equity, having only debt, etc. And this is pretty much evident in the relationship that says that the beta of the unlevered equity equals, again, the weighted average of the beta of the levered equity and the beta of debt. It is pretty much one-to-one relationship whereby you change RU to beta U, RE with beta E, and RD with beta D. Okay? And so this is what it tells us generally, what this theory tells us generally when we have or when we are under the case of perfect capital markets. But of course, this is not the case, as I said before. Markets are far from being perfect. What we see in the data, and this is what has triggered different economists or financial economists trying to think of what's happening here, is that they saw that most firms actually consistently having differences regarding how much equity or how much debt they had in the first place, right? So something happens here. Why some firms prefer to have different capital structures? And this is, of course, due to market imperfections. When you have market imperfections, you always want to capture any potential arbitrage opportunity and use this opportunity in your favor. That is to capture any potential extra value that you can. And a main player here is taxation. The point with taxation is that it always increases the probability or the incentive of the firm to have more debt. And why is this? Because of the interest expense. The interest expense, that is, if a firm has an amount of debt to pay, an interest, for example, for this amount of debt, this is exempted from corporate tax. So this creates an extra advantage. And also the issue here is that a firm can always be better off with leverage, even though its earnings might be lower, because this is what I said before. Even if the earnings might seem to be lower, at the end of the day, because you got something from this tax exemption, because of the interest expense that you have, eventually the value of the firm at the leverage level is higher under taxation. All right. And why is this the case? Because of course you have the debt holders and we have also the equity holders. We have to count both of them regarding the value of the firm, because the value of the firm incorporates all potential assets of the firm. And what we have here, we have something that is called the interest tax shield. The interest tax shield is practically the corporate tax level that every firm has to pay in specific countries, multiplied by the interest payments. And if we see a relationship, if we try to see what is the value of the firm when it is leveraged versus when it is unleveraged, you will find out that the difference between a leveraged firm and an unleveraged firm is exactly this difference in the interest tax in the interest tax shield, the present value of the interest tax shield. Okay, because the present value of the interest tax shield tends to be a positive number, is a positive number, the value of a leveraged firm is always higher than the value of the unleveraged firm. And what does this mean practically? This practically means that the cash values, right, that the cash flows to investors with leverage are higher, larger compared to the cash values, that is the flows that are going through the through investors without any leverage. This is what this relationship tells us. All right. Now, when we have taxation, it is important to understand how the average cost of capital changes. The average cost of capital under perfect markets, as I said, is the same. It's very similar. But this is not the case. That is stays always the same. It's horizontal to the. Yes, it's horizontal to the horizontal axis of d over e plus d. But when we have um, taxation enters in the relationship between the cost of weighted average cost of capital, because now the weighted again the in the relationship between the WACC, RE, and RD, we had weighted values regarding how much equity and how much debt a firm had. But now, when we have the relationship about the debt, we also have to multiply that by 1 minus tau C. Tau C is the corporate taxation. And this, of course, the relationship, which is in your book as well, and you will see it as well, has a minus sign in front of it. The minus sign indicates that as long as the value of D increases, that is, the more debt that you have, the smaller is the average cost of capital. So if we wanted to actually have a graph where in the vertical axis we had the average cost of capital, okay, vertical axis, the average cost of capital. And on the horizontal axis, we had actually the, let's say, the ratio D over E plus D. Then in this case, you would see that when we have taxation, the cost of capital starts at a specific level, let's call it, I don't know, 100, and then the more debt you have, it starts decreasing afterwards, okay? So this is practical, why we say that having debt actually increases the probability of firms or the incentives of the firm to actually utilize debt instead of only equity, okay? Then, apart from these corporate taxes, we have to take into consideration personal taxes. And what are these personal taxes? These personal taxes might come, to debt holders when they get something as an interest on income tax that they have given, called this tau I. We also have for individuals who are shareholders of the firm, they might get, dividends or any capital gains. These things are taxed twice, one at the firm level and one at the individual level. And for example, for $1 that an individual would have expected to get because of taxation, he gets much less. And how much less does he get? He gets, instead of 1, he gets 1 minus tau C, multiply that by 1 minus tau E. Tau C and tau E are the corporate taxation in the first stage, as I said, and tau E is the investor taxation, okay? So what is the difference between how much a person is paying as when you have interest, that is debt, and how much a person is getting or paying when he has a dividend to get? This difference between these two is the effective tax advantage of debt, and practically tells you how much more benefit is created to the firm or to the investors of the firm by having debt instead of having equity. And this is the relationship or equation 15.7 in your book at chapter 15, okay? Okay, we can have different situations here where, difference between tau C and tau E or tau I, and can see how this value changes when these different corporate taxations or different types of taxation change. We have done in the previous you had an exercise to deal with it. And now, finally, I wanted to tell you something about the optimal structure. So eventually, how, if you were, let's say, a manager of a firm, how would you structure your firm? How much capital, how much debt, how much equity, how much debt? As we said, under perfect capital markets, M&M1 theory one, it doesn't matter how much capital, how much assets, how much that you use, because everything is optimal over there. But under taxation, interest payments, asymmetric information, things matter a lot, and you have to take them into consideration. So what do you do? You would be better off, or you would be optimal in a firm that that has to pay taxes when the interest expense on the taxes equals exactly the interest before income taxes, a bit. When the interest expense is exactly equal to a bit, then in this case you get the highest possible value of the firm. What do we know? We know that firms prefer debt in reality, but also we know that firms, and we have seen this in the data. On average, firms use more debt than equity. But also, if we try to check the data whether this is an optimal condition or not, we find out that on average this is not an optimal condition. And what do I mean that this is not an optimal condition? I mean that firms on average do not get the optimal value of debt. They are under leveraged. They should have taken more debt in reality than what they actually do. And what are some reasons for this? Of course, some reasons for this is that, we set the optimal condition, you need to know EBIT, but the EBIT is a profitability index. You don't know exactly from the beginning how much you will have. You can have only different scenarios, right? And the other thing is that there might be other potential issues when you have a lot of debt. Can you tell me any potential problems when you have a lot of debt? Any idea about this? Why, when we have a lot of debt, what else is in the minds of directors when they have to incur a lot of debt? What happens to the firm or to themselves also when they have a lot of debt? Do you have any idea about that? So let's say you have a firm, right? And this firm has a lot of debt. What does it mean for a firm to have debt? Let's say from a big bank, or from a big bank or a number of different banks. If a firm has increasing risk of default, correct, usually there is an increased risk of default. What else? So, trying to make a condition here. Let's say that you have a covenant of many people, many banks, or many potential lenders, and these lenders want to give an amount of money, and they give you this amount of money. But what do these lenders want from you as a firm? What do they want? Can you, let's say, your activities as a manager or as a firm will be the same as before? Will you have the same level of freedom? Right. So Simon says that there is a collateral issue, and exactly I wanted to go into the specific area here, the collateral issue, because when you have people giving you money, they want their money back, of course, and they want their money back with an interest amount of money, an interest, of course, right? So if you are a manager and you're used to having a lot of free cash flow, and therefore using this money perhaps for your packs as well, or doing, for example, takeovers that do not add value to your firm, then of course they wouldn't want that, something like that, because this would add a high risk to your being able to eventually pay them back. So they will put covenants or collaterals. They will need you to actually, give them something, a big piece from the firm, or be sure through covenants that you do your best in order to pay them back. This would mean that you cannot do any kind of investment as before. And also, of course, as Gubin says, stable cash flow, of course, because sometimes debtors do not like, or how to say that, lenders would not like you to have an unstable cash flow. They would like a stable cash flow, so they know pretty much how much to expect from you, and therefore, to reduce the risk as much as possible. All of this come together by trying to tell you that when you have debt, there are also other issues that you have to consider: potential of having a default, potential of having problems with financial distress. And if you are a financially distressed firm, what kind of problems can you have if you survive in the market afterwards? There are some costs, I would say, direct and indirect costs here. Can you name a few? So what are some problems? Say the market has found out, because information travels very fast now, and we can easily see information regarding different indices or how good a firm is doing. So let's say you're a firm, and it has been found by different analysts that you didn't do well this year, or for a couple of years in a row you didn't do well. You had financial distress or problems, really big problems. You wouldn't be able to pay your employees, to pay your suppliers, all of these kind of things. How do they affect eventually the survivability of the firm and the ability of the firm to continue into the future in a better standing? So what can happen here? So a firm also does not operate on its own. It has to use, if they produce a final product, they have to take raw material from somewhere, right? So if I take material from somewhere else, right, and I have been known to actually having financial problems, what will my supplier do? An idea? Yes. So an idea here would be, for example, for the supplier to stop supplying me. It could be the case that he would stop supplying me or providing fewer supply. So I would have to look to someone else. This would indicate for me that I had to, the cost of actually finding another supplier, creating the ties with another supplier, and this incurs a lot of cost. At the same time, you also have the issue that sometimes suppliers might also help a firm by providing trade credit, as we call it. This means that in some yes, someone wanted to say something, because I believe that there is a someone who has an open microphone. If you want to say something. Okay, so we also have, the case of, as I said before, we have the case of trade credit. Um, yes, so yeah, so let me finish this about the trade credit, and then I will go back to Jason's point here. Is that trade credit is another form of credit taken by supplier gives you money or tells you, for example, you don't have to pay me now, you can pay me in the future. So it gives you a leeway for a period of time. While this wouldn't be the case for a bank. With a bank, for example, you have to pay interest on the debt no matter what. So you might lose this kind of trade credit. Nobody practically you lose trust by other people in the markets. And of course, when you lose trust, is what Jason says. The supplier may ask you to pay previous payments. Right now, for example, if you were in trade credit, they will tell you, you got to pay me now, or because they know that something is happening here. They are afraid of their money. And of course, when this happens and you have this kind of problems, you start with a small, let's say, financial distress, but then there's a whole circle of events, one after the other. It's a spiral that eventually might make your position much worse in the future. And that's why we say that firms that have financial distress may have very high probability actually exiting the markets. All right. So pretty much this is what I wanted to tell you about a small summary of the information that we had about this capital structure. And now we'll try to go into activities 3 and 4, provided that you do not have any other question regarding the material that I described already. Now I will go to the activities. Okay. So now, okay, let's go to the first one. I would like you to know here that the way that I post this kind of questions here will be similar in your final as well. So in your final, you will have general corporate finance questions relevant to what you have done already. You must be able to find something, or papers, in order to discuss based on different theories. So I guess that this is a good exercise for your final as well. So what is this? What is the topic of this activity here? It tells you that you have supporters of efficient and integrated markets who argue that the costs of different forms of finance should not vary independently. That is, there should not be any gain from opportunistically switching among them. But there is evidence showing that equity market timing is important for firms. Discuss this puzzle, of course, with your colleagues, etc., and consult the literature for potential answers. In your answer, include the different theories that have been proposed, as well as data cases that support them. So sometimes, in order to answer your question, you find something that is relevant with the question asked, of course. You find the different theories over there, but it is also important for you if you are able to somehow support it with data. And of course, you can find this kind of information in the papers that you will have to read in order to answer the final questions. So tell me, has anyone tried to tackle this question here already? Did you find any paper that is relevant? Or any idea that you might have about this? Do you believe that actually managers time the market? Let's start with this question. Do you believe that this is happening? But timing the market, we mean that, under certain circumstances of the market, people have incentives to do one action or another action, but consistently they do that. So there is a dependent variation, actually, not an independent variation, as the supporters of the efficient market would assume. How do you think? Okay, let me try to go into details here. So a main paper that studies this is a paper almost 20 years ago, was published in 2002 in the Journal of Finance, a very important paper by Baker and Wurgler. It's called The Market Timing and Capital Structure. Okay, so practically here, they introduce a new theory, the market timing theory. And after that, this paper has been cited almost 6,000 times. So many people have read it and, of course, have advanced potential theory or have utilized new data. What is this equity market timing? The equity market timing, practically, as the authors call it, is the practice of issuing shares at high prices and repurchase them at low prices. Why do they want to do this? Of course, it makes perfect sense why they want to do this, because when we say that a firm issues shares, it means that a piece of share will be sold to someone, and of course, you want to sell this to someone when the price is as high as possible, so that you increase the income of your firm. You can use it for investments, and when the time comes for you to repurchase shares, there are reasons why a firm repurchase shares. We'll talk about that in the next lecture, dividend payout policy. By the way, this dividend payout policy is already open, and as I told you yesterday in the email that I sent you, I would like you to already start working on chapter 17, and also have an idea about the different activities which I would like to discuss with you in the meeting. Anyway, when you repurchase your shares back, that is, you buy your shares back from different equity holders, of course, you want to do this at the smallest, lowest price available to you. Why do you do this? Well, you do this because potentially there are temporary fluctuations in the cost of equity compared to other forms of capital. So you have found potentially that there is some probability of having arbitrage opportunity over there. You're going to make money as a firm. So that's why you want to do this. Of course, in the textbook material of Modigliani and Miller and Perfect Markets, you wouldn't have expected something like that to happen. But in reality, something like that happens all the time. And this is what this paper tells us eventually. And why you have this kind of market timing? You have this kind of market timing because you have inefficient markets and also segmented markets. When you have all of this information together, this indicates that there is asymmetric information. Some people know better than others; they can exploit arbitrage opportunities. Some people don't know much, so these people lose from the market. Or you have when you have segmented markets, practically, you have different sectors or industries or markets or whatsoever that they do not know exactly what's happening to one another. Of course, this creates additional asymmetric information, and of course, probabilities of actually having arbitrage opportunities. The low one price does not hold in this case. So market timing under these conditions, you benefit ongoing shareholders, and of course at the expense of entering and exiting ones. What does it mean? When, for example, the ongoing shareholders will be better off because you exploit opportunities, you increase the firm value, but those people that leave might have to sell in a smaller, might have to sell it in a smaller price, or those who actually enter, they have to, to buy a share at a very high price. And this is what we said here practically. So that's an issue here. Any question? All right. Go to the next one. Is there any evidence of market timing? So why practically? What is the motivation of this question? Why do they want to study this? Now, if you see analysis of firms, you will find out that indeed firms tend to issue equity instead of actually equity. They try to issue equity instead of debt when market value is high, and tend to repurchase equity when the market value is low. So this indicates that there is a temporal effect over there. There are times when one investment is more probable than the other. And also, if you see the effects on the value of the firm afterwards, after managers have opted to follow a specific policy, you will find also that controlling for everything else, that these kind of policies eventually increase the value of the firm, which is very important, of course. So in the long run, they have checked, for example, abnormal returns, or they have checked operating outcomes of the firm. They have seemed to be successful. And also, it seems that firms tend to actually issue equity at times when investors are too enthusiastic about earning prospects. Now, I want you to take into consideration the authors that wrote this paper. The authors that wrote this paper are Baker and Wurgler. So these people are very well-known individuals who have studied the sentiment of the markets. They have studied the behavioral finance aspect of it. So they are very important researchers on that area of research, on this field. Therefore, they talk about enthusiasm. Of course, when there is more enthusiasm in the market, the sentiments are high, spirits are high, and in this case, of course, investors would like to buy more. Even they do not consider so much the price in this case because they believe that price will increase even further. So some people try to exploit that. Now, and of course, the final information that they give us is that indeed, even managers themselves say that they have done something like that. Where do they say that? They say that in an important survey that has been done by Graham and Harvey in 2001. And when they ask, managers, of course, without them giving their name, they ask them, do you actually do you do any market timing in the process of issuing debt or issuing equity, etc.? And they said yes, we do. So this is, of course, a first-hand information about this practice that has been done. Of course, they wanted managers to be anonymous about this, because if they were to say something like that out loud, then it would mean, that the managers are not actually trying to do something that is best for all kinds of investors in a firm. We say that it might be good for the ongoing ones, but it might not be good for those that are exiting the firm or those that are actually trying to enter in the market by buying shares of this firm. Okay. because people would know that they have been fooled, and therefore they would not participate at all. They wouldn't buy any shares of this company. That's why it has to be anonymous. Another question is, remember what I said before, the long run effect seems to be positive. So is the timing also different at different periods of time? That is the potency different of the effect? Is the potency of the effect different in the short or long run period? Now, if you try to see this mechanically, you will find out that you need to have a mechanical short run impact. Mechanically, by doing this action, at least for a short period of time, you should find something. But what does the normative capital structure theory tells us? Eventually, firms will rebalance, it tells us, any influence, rebalance away any influence of market timing, financing decisions. So eventually, you will get to something that persistence will be lost afterwards. And for this, therefore, you have two different opposing theories. And what do you want to do? What do you want to do is to see which one prevails. And how to check which one prevails? There is only one way. You have to use data, because there are many theories, but eventually data will tell us which theory is strong or prevails at a specific period of time, given the period of time that we study the data, but also the country that we study the data. Now, what are the preliminary findings of this work? The preliminary findings of this work indicate that high market valuations reduce leverage in the short run. Historically, if you see the data, they also say that in the paper, they find that market valuations are associated with lower leverage in the cross-section, that is, between different firms. But this would indicate, in the first place, that the market-to-book effect is very strong, at least, and very persistent. And of course, when this is the case, when you have, that is, you see some data, you see some time series, you find a persistent effect over there in the time series. But now you need to be able to measure that. And how to measure this persistence? Because that's important for this paper. They need to measure this persistence. But fortunately, these authors tell us that there is a way to measure persistence. And to measure persistence, they use a very highly influential work by Rajan and Zingalis, a paper in 1995. They also cite in their work which paper is that. So you have to control variables that are going forward, and you have to have a specific point in time where you start measuring or counting the effect, measuring the effect. And an event that makes a lot of makes sense to actually use is something that you have seen already before in your second second week, and that is the initial public offering. Why we use initial public offerings? Well, we use initial public offerings because a firm tries to become a public company because it wants to issue shares, it wants to grow even more. So what would be that would be a very good actually case to study. For IPOs is an event. An IPO is an event for the firm. We know the date that this has happened. So when we know the date of an IPO, we can examine the behavior of leverage around the period of IPO. So you have an event and you want to see what happens around an event. What can happen in this event? You can see, prices changing. Usually they start increasing, they're quite high in the beginning and then they go down. But in any case, there are even in this case, although there is a general pattern over there with the prices, how they go before and after the IPO, or go to the IPO and afterwards, the point is that there are heterogeneities within. Why is that? Because the IPO is a decision that is relevant to the market-to-book ratio. Therefore, when we know the IPO date, we have an event analysis that we can do. We can evaluate, study the evolution of leverage from a fixed starting point. Now, okay, so what can we do now? We know that we have a way to measure this. But now it's very important also to be able to show this in numbers. So how do they use it? How do they do it? Now, in their paper, if you see their paper, they have many types of models, different models, but I will pay more attention to this specific one here, specific equation here, which actually tries to show you how, the difference of the debt to equity ratio differs or changes after the IPO period or pre-IPO period. Now let's see what this equation is, because we need to understand what this equation is and the different components of it. In the left-hand side, which is your dependent variable, you have a difference in the ratios D over A. This is in the paper, it's called net debt issue. It is the residual change in assets divided by assets, practically. So you have a difference for a period pre-IPO and a period T. It doesn't matter what this period T is, but this period should be after the IPO, of course. Now you have a bunch of different controls, and the main control that you have here, as we said, is the market to book ratio. And this market to book ratio needs to be done needs to enter twice here. And the reason for this is because the sub-index EFWA here indicates external finance weighted average. So you need to have that as well. It's a technicality. I would not expect you to know much about this, but just technicality to see and for you to understand, if you decide to read the paper, why you have two M over B ratios here. These are not exactly the same thing. Okay. So you have market to book ratio, which is a very important control, and used when you have when you study firms, you usually have this control. You also have controls such as property, plant, and equipment, denoted by PPE over A. This is the scaled version of it. And why do we use it? Because this is practically a proxy for tangibility, for asset tangibility, what a firm can as practically tangible. We need to have information about the profitability of the firm. And again, to measure the profitability of the firm, we use the scale, the value of earnings before income taxes and any dividends that you might give. Remember, all of these values are scaled. When I say scaled, it means that they are, monetary. If you don't have indices, the monetary values, for example, PPE, EBITDA, etc., should be divided by the assets of the company. Or else, if we don't do this, then many big companies will always appear to be bigger just because of their sheer size. Okay, but that's not right, because we have to be able to compare them accordingly. And always in this kind of research, you always have the how big a firm is practically. Is the log S is the firm size in monetary units, and we use logs. And the important question that I ask you here is, why do we get logs instead of pure number here? So why don't we use just, I don't know, 200 million, 300 million? Why do we have to use logs when we use assets? Any idea? That's a technical issue regarding the regression per se, but in any time that you have to use firm level information and you have to do regression with control, with having size as control, you have to use logs. Do you know why? Okay, too big. And what does it mean too big practically? It could be too big, yes. For some companies, for example, could be for Apple would be huge number. For Micron will be huge number. So why do we do this? The difference. It's not really a difference here, Robin. It's it's a logarithm. What does it mean? I want you to tell me something. It's a technical issue. I'm sure that you have done this some point in your econometrics course. And because you have done it over there, you have to understand here with the data why you did it. What did you say in your econometrics course? What did you say about the different variables? Or what did you say about the error terms, all of this kind of stuff? You need to have some assumptions. And one of the important assumptions is, what is one of the important assumptions when you run linear models? This is the key. If you know this assumption, it's called normality. Not necessarily percentage effects. It has to do about normality here. The normality and the distribution of different variables. Okay? The size, if you see, for example, the income of individuals, if you study the distribution of income of individuals in a country, in every country, if you study the size of a company monetary units in every country, you will see that this distribution is not a normal distribution. That's not good, because it does not really tell us what is the effect over there, and can create bias to the results when we have skewed distributions. Practically, The size would be kind of a Pareto distribution, is skewed to the left. There will be a lot of mass to the left side compared to the right side. That is, you will have just a few firms that are very big, but they are dragging the whole distribution. But that's not good when you do the regression. Okay, so that's important here. That's important here. That's why when you take logarithms, so make this exercise to yourself. You have a series of different values that are, I don't know, income, size, whatever of a firm, and try to make a distribution over there. And then take the logarithms of this series and try to make the distribution over there. You will see that the new distribution with logarithms will be closer to normal distribution, okay? And that's why I do it. This is a technicality issue, but we have to do it in all cases where we have this kind of distributions that are skewed. We don't do this for percentages or for ratios, because ratios are already practically already distributed. Any question about this technicality? Okay, so this is how they do it. So they check under the many checks that they have. They use this formulation here. They take Rajan scales and then introduce their try to see if their theory works. So what are their findings? Practically, also this is true, Jason. Indeed, when you take logarithms, you have a normal distribution, and eventually, all the extreme data will be lost over there. All they will come closer to something that makes more sense. Because if you have extreme data, practically this is it. When the distribution is very skewed, you have some firms, for example, with very high size, and these firms would be, let's say, an extreme point in your. If you try to make a diagram with different points, you will see that they are very extreme, and usually these extreme points drive the result, may drive the result or the relationship, and they create bias eventually. That's why you don't want to do this. Okay, nice point, Jay. So logarithms, practically, this is what they do. Now let's see their findings. They find that the results are consistent with the hypothesis that market timing has large persistent effects on capital structure. The low leveraged firms are those that raise funds when the market valuations were high, while high leveraged firms are those that raise funds when the market valuations were low. So there is a cross-section difference between the different kinds of firms. There's the heterogeneity, which is good for their theory. The leverage is strongly negatively related to historical market valuations. The influence of past market valuations of capital structure is quite persistent. So they see a lot of persistence here. So something that has been done in the past continues to happen now as well. And also fluctuations in market value have very long impacts on capital structure. So their findings practically set a cornerstone in this area of research about market timing. All of these kind of findings are actually saying to us that indeed there is market timing and the effect is strong. And the effect is not only strong in the short period of time, but it seems that it follows a firm even afterwards. Maybe even when the manager of the firm leaves, because the market, the culture of the company, if we say this way, or the practice of the company are already embedded over there. What kind of theories do we have about this? One theory that people will try to say here is the so-called trade-off theory. Trade-off theory in perfect markets tells you that capital structure is irrelevant, but the trade-off theory determines, again, an optimal structure while you have imperfections. And like we said, for example, that the interest you pay on taxi should be equal to the EBIT, for example. But still, this theory assumes that markets are efficient and that information is symmetric. When you say this, we mean that when an event happens, it is absorbed very quickly by the markets, and then it continues to it continues like that. But there is no pre-trend or after trend when you have efficient markets. And what is the main prediction of the trade-off theory? The trade-off theory tells us capital structure eventually has to adjust to the changes in the market-to-book ratio. But if you see the data or the findings of this work, you will find out that this does not bode well with the findings of this paper. Right? The pecking order theory. Under this theory, there is no optimal capital structure. You just use what is the best available choice for you, closer to your hand as possible. According to this theory, the market-to-book ratio is a measure of investment opportunities. Now, if you see Myers' 1984 paper, high growth firms reduce leverage. Why? Because they want to avoid raising equity as investment opportunities arise in the future. The result of Baker and Wurgler do not seem to be in tandem with this theory either. So what is it then? Managerial entrenchment. Let's see here. So we have to see the role of managers here. According to this theory, this is a theory 1996 by Vibel, says that high valuations and good investment opportunities facilitate equity finance. But when this happens, usually managers become entrenched. And we know managers, when they become entrenched, they want to have their life as easy as possible. But they want to have as much as free cash flow as possible. And this does not happen when you have a lot of debt. That's why I say here that, when managers are entrenched, they may refuse to raise debt. When we have more debt, because we discussed before, the above decrease the power of the manager. You have the lenders on your head telling you, you should do this, you shouldn't do that, you have to follow this, you have to follow that, because you have to pay that back. So manager loses power. And so what the managers would do, they would try to perhaps exploit existing investors. But this theory is somewhat related to the findings of Baker and Wurgler here, because we see an effect, both in the short run and in the long run period. And of course, they come finally to their theory, which has two versions, the so-called market timing theory. They say this is the most appropriate theory to explain our findings. According to this theory, capital structure evolves as the cumulative outcome of past attempts to time the equity market. Okay? It has two versions. One that is a form that is, relevant to Myers and Magel of 1984. It's a dynamic form. It indicates that there is an adverse selection cost that vary across firms and time. And then there is a version 2 that is the irrational form that tells you that you have time varying mispricing. Managers issue equity when they believe the cost is irrationally low and repurchase equity when they believe the cost is irrationally high. But that's not an optimal decision. It's a behavioral part over there. And that's problematic. But it seems that their market timing theory works in the data. Can they say which version of the theory is correct or not? No, they cannot say that. But the evidence, however, supports that the mispricing version comes from the low long-run stock returns following equity issues and the high long-run returns following repurchases. So this is kind of relatively closer to version 2. It means that there is a behavioral effect over there. It seems that there is an irrationality in the markets. All in all, what we can say here is that managers are successful at equity market timing because, first and foremost, they are able, this kind of practice that they follow, show afterwards in the firm's profitability in the long run period, which means that what they do now potentially can increase their value in the future. Any question for this? Any question for this? If not, then we'll have the group activity. The group activity is the activity that you had to do for your work. And I would like you, prior to actually going I will make groups again. And I would like you to, to use this information here, talk to each other for about 10 minutes, and then eventually we will discuss this based on another paper. I see you how the job is done here. Okay? So I will put you in groups now. Breakout. I will assign you automatically, okay? my screen once again. Talk about this specific question here. And chat as well. If there are any questions, and give me some time, please. Okay. Right. So, do you have an idea about this question? What can we say generally about this? Do you believe that there is an effect here, and under which mechanism does this effect works, or operates? How if there is an effect, how this effect meditates as firms become older and older. So practically here I want to hear that indeed there is a mechanism under which when firms become older for some reason, that is as their age, as they be part of the market for a long period of time as they age, they still seem to change somehow. There is a change over there. Can you say anything about that? It can be anything. I mean, whatever you have in mind, at least if there is a mechanism behind it that you can say, we can discuss later. Of course, we'll discuss later, but I would like to also hear from you saying a few words before going to the specifics of it. First of all, do you believe that age matters here, or we will not see any effect at all, or that there is no effect? Let's start from a gut feeling, let's call it. So, when firms become older, do they change? You can say, or you can write in the chat. There's no problem with that either.
Maybe when the funds go older, it may have more debt.
Okay. So you believe that firms, as they become older, they might have more debt.
Yeah.
Do you believe why is that? Why do you believe that will be the case?
Generally, if a firm want to develop, it may require more capital to develop itself. But actually, in the beginning, after the IPO or others, he gets its equity may not have be require more, but when he could mortgages some capital from the bank or other channel he could issue bonds. So I think the debt may be more than the beginning.
All right. So practically, the mechanism that you say here is that as the firms age, they become older in the market. People know them. They get more trust, let's say, by the different financial intermediaries such as banks, or they can issue debt with lower cost, etc. So maybe in order to grow more, they accumulate a lot of debt. That's a mechanism that you have in mind. We'll see later what the data say and whether you are right or wrong. But do you also, guys, believe that? Thank you for this, Kunhal. Do you believe, guys, that also the corporate governance of a firm will change as well? Because we want to see here how corporate governance, what is the mediative effect of corporate governance to the effect of the age of a firm on its capital structure. Actually, there is this heterogeneity here that we need to have in mind prior to going to the results. Any idea? These were all very fair points that were described by your colleague here. But let's see what the data tell us now. Again, of course, this is not a question that it's a question that somebody can ask. But of course, this had been asked already by researchers. And practically, there is a paper that is relatively new, 2018, at the Journal of Corporate Finance by Kichnik and Musawi. Now, let's see some background here. Let's try to understand what's happening. As firms age, especially after an IPO, first and foremost, their governance needs to change to reflect its different needs. This is what Filotachev tells us and co-authors in 2006. Why is that? Because a firm before the IPO is a small firm, but then it becomes bigger and bigger. It needs to change its governance because now they do not care only for a couple of people within the company, but they care for all of the shareholders and potentially stakeholders as well, if the company wants to be also ethical. Then this means that the costs and benefits, for example, of takeover defenses or any other corporate event, changes as firms become older. After a firm's IPO, now the costs tend to outweigh the benefits as firms age. And also this is reflecting its valuations. So as cost-benefit analysis tells us that there's a difference over there. We expect at least governance to change as well. And then we'll see what happens to the capital structure. Now, by all of this information, I mean, you have some triggers over there. You have changes. It would be unwise not to change as well as a firm. So we expect some change to happen. There are some technicalities, as these authors say here, of how to measure stuff. For example, how you measure equity is not the opposite of that and vice versa. Book value of equity is just a accounting number, so does not tell us much information. There are non-linearities, so it's not just a noise or regression. You have to take into consideration non-linearities. If you just use the ordinary least squares, for example, then what you're actually capturing is a first-order approximation, as we say, and that could be biased. It might not tell us the whole story. And the word debt, which is more frightening, is that it's not. It does not mean the same thing for all people in different firms and also different researchers. As you will see, when people define debt, they define different ways. So, okay, having these issues and technicalities, they want to see what's happening then. They have to use data and models, of course. US data, because it's easier to get all this kind of data. They have to use firm information data from CompuStat. They have to use some information about the society on its own, the economy on its own. So they use FRED data, Federal Reserve Economic Data, which have macroeconomic information. If you want to do something about the United States, you may find data there as well. Now, for governance, they use the risk metrics database. This database, I do not believe that we have it in the University of Glasgow last time I checked. It's a really rich one in terms of corporate governance characteristics. But we have others. We have, Bordex, etc. If you want to use for your research. And then the authors try to create a measure of capital structure. And what is their measure? The measure of capital structure is the ratio long-term debt plus short-term debt divided by long-term debt plus short-term debt plus market value of common stock. Now, technically, this ratio is made to take values between 0 and 1. Maximum will be 1, minimum will be 0. If you see the data, how this distributes, again, it has the higher mass on the left side, closer to 0, that is. Having this kind of information, they need to see what kind of corporate variables they will use. So they use board size, how many people they have in the board. This is the standard characteristics of corporate governance. How many, for example, insiders do you have in the board, corporate insiders? GIM and D indices. These are standard indices that have been done by specific authors. The GIM index by composition metric and the E index is by Bebchak and co-authors. Dual stack stocks indicate whether you have dual stacks because not all the time stocks are the same. They have different voting rights, of course. If one stock counts for 2 or even more, of course, this makes a lot of sense to matter for governance when you make decisions. They have information about the CEO chair, whether the CEO is also a chair of the company, of the board of directors. This is also called CEO duality, and also have other standard controls at the firm level, which are always your firm size, market to book, all this kind of stuff. Then, what are the findings? Now, the firm age, as it seems, is negatively correlated with the firm's use of debt. Given that the firm uses debt, so if a firm uses already debt, as the firm becomes older, it will use less debt. Okay? Why is this? This is because of the interaction between firm age and its governance features. So this effect does not happen on its own, but it happens through the governance interaction mostly. Why I say this? This might be different from what your colleague said before, but you have to take into consideration why is this is happening. Okay, so if you start with debt, if you are a firm that uses a lot of debt in the beginning, then it seems that through governance mechanisms you will use less debt afterwards. This is what it tells us here, and we have examples for that. For example, Apple is a company that does not have much debt actually, which is a huge company, has been around for more than 30 years, right? What they also find is that dual class firms are more likely to be all equity firms initially. So they start with all equity, no debt at all, but they are more likely to use debt as they age, if they are public corporations. So this is something that is relevant to what your colleague said. You know, it depends where you start practically. If you start with a lot of equity, then eventually you will use some debt. If you start with a lot of debt, then eventually you will use less of it as you become older. Let's see, all of these things indicate, of course, that a firm that there is no, the answer is not that simple. That is, if happens this way or happens that way. In economics and finance, generally, you have to describe channels, and sometimes you have channels that are in the opposite directions. And the final outcome depends on the circumstances. Okay, so to have a mastery on these things, or also when you answer your final questions, try to always have in mind the fact that a question is not that always simply to be answered. Okay, and especially the critical type questions. Also, as firms age, its board composition changes compared to when firms were young. For example, firm age is negatively correlated with how much debt financing a firm uses. Okay, by and large, as firms grow older, entrenched managers have more to say, and their preferences matter for a firm's capital structure decisions. But remember what we have said before: entrenched managers are these agents who, of course, do not like to have a lot of debt. They want to have a lot of debt because the more debt they have, the more people they have to tell them to do things. That is, they have lenders telling them how to run their company. Maybe they want to run their company in a different way. Of course, lenders have their own incentives. They want to get their money back. The managers have their own incentives. Since nowadays, with the governance, change of governance has happened in many countries where managers are also shareholders. They might want to increase firm value. They might want to take care of shareholders, but sometimes they have their own incentives that are relevant to the incentives of the general shareholder. Therefore, we have agency issues. So generally, managers on average want to have free cash flow to use their money as they want. Practically, we'll also talk about this more specifically when we describe the issue of mergers and acquisitions, which is one of the most important investment decisions of a firm. All right, so this is what I want to show you here. Practically, also for your for this part in the forum, I wanted you to write simple stuff like that. That is, you would have gone to Google Scholar, you would have found maybe this paper or another paper. There would be many relevant papers about this. And I wanted you to say something like this: this paper studies this, finds that because of this. A couple of words like that. I didn't expect you for this kind of activities to actually write all of this stuff that I have written here, but I wanted you to just write a couple of words about this. I found this paper, they do this, things like that. This is what is missing here. Yes? Question? Yeah, so practically, this is it. I mean, also for the other paper, for the other week, you are supposed to read one paper over there. I have already posted the paper. I'm not asking a general corporate finance question, just a paper. So please try to have a read on that paper and try to answer a couple of questions. I don't want it to be, huge like that. Just a couple of sentences about this. That will be enough. And then, of course, when you come to the meetings, I will describe in detail what we have in that paper. But it's a good idea prior to doing that. I want you guys to also read it so we can have a fruitful discussion about it here, so that I will not be mostly talking. I want you to also talk about this. Better way for you to learn, and also a better way for you to actually be able to deal with your final questions. Anything. I mean, starting from your coursework, which needs to be critical work, to also to your final, which will be doing your final on your own. So you need to develop this critical thought, be able to maximize the potential grade of this course. This is what I want. I want to see critical thought here. Okay? Any other question? Pretty much I'm done now. I don't have anything else to say. I will post, of course, I will post this information in the unit that I have, this PBTX file, and I will also post some answers to the case of to the data case that you had to do the previous week. All right? Questions? All right, then, no questions. Thank you very much for coming today. I'll see you next week. Take care. Bye.